Hey guys, what is going on? Welcome back to the channel. Today we are going to be discussing housing affordability because it remains a headwind in today's housing market. And a lot of that has to do with higher prices. It also has to do with rising mortgage rates. So we're going to give you an update on mortgage rates, and we're going to talk about buyer demand and how, despite the challenges or the affordability strains that we are seeing today, housing inventory is still moving, transactions are still taking place. We're going to talk about what is actually causing that. So if you're new to the channel, I make these videos to keep you updated on the housing market. We talk about all sorts of stats and facts. We give mortgage rate updates. If you're into that sort of thing, consider liking and subscribing. And let's go ahead and jump right into the video. So the first thing that we have to talk about is mortgage rates. And in order to do that, let's pop over to CNBC. Let's take a look at the 10-year treasury yield. Mortgage rates are loosely correlated with the 10-year treasury yield. So in other words, if the yield here on the 10-year goes up, we generally see mortgage rates rise with it. If it goes down, then we see mortgage rates fall. So as of today, this recording, we're sitting at 4.7%. This is a year chart right here. You can see back in October of last year, we actually saw the 10-year just touch about 5%. Now, at this time, mortgage rates had risen to just around 8%. So we're not far off, to be honest. But we're sitting at 4.7% right now. So we got, what is that, about 30 basis points left to make it up to that 5% range. Now, this is obviously driving mortgage rates back up. And if you look at where we were over the last 30 days, you can see it's taken a rather large move. This isn't typical volatility that we see in the 10-year. So this is a rather large move here over the last 30 days. Now, if we pop over to Mortgage News Daily, this actually gives us an update on where mortgage rates are sitting as of this recording. Now, this is just a national average, but nonetheless, we can see that the 30-year fixed on a conventional loan is now hovering just over 7.5%. And we see the Govy product, so FHA, VA, they were sort of floating in the upper 6% range. They are now just barely creeping in to the 7% range there. Now, if you take a look at this chart here, you can go back, we'll look at a 30-year fix. This chart kind of gives us some insight to where we were over the last 12 months. So right now, we're here at about 7.5%. You can see in the last 30 days, we went from the upper 6s right to just into the mid 7s. And going back to October of last year, like I mentioned, we touched 8% for just a brief period of time. And by the movement that we're getting recently in the bond market, I mean, it's possible. We could see rates kind of continue to tick up, maybe into the upper 7s, even touching 8% range again. But time will tell. So we'll continue to monitor that here, at least on a weekly basis. But so what does this mean? How does this actually impact affordability? What does it look like as far as monthly payment goes? And how does it, in fact, strain affordability? So let's pop over to Redfin here. Redfin is a search engine here to see all the homes on the MLS. Let's go ahead and pull up an example. I'm in the Northern California market. Let's pick on Sacramento here, and we'll just pick out just a regular home here. Okay, let's do this one. Here we go. This is probably about the median priced home in Sacramento. It might be a little bit higher, matter of fact, but let's take a look at this property. Looks like a lovely home in the Sacramento region. It's listed at $515,000, and if we scroll down, we can actually work off of their mortgage payment calculator just to give us an idea on what we're looking at. So let's adjust some of these figures slightly, but let's go here. Let's start with the down payment. So we know the purchase price is $515,000. The average first-time home buyer is coming in, I think, at about 7%. So why don't we say the down payment in this case would be 10% down? And then we're going to put the 30-year fixed where the average is today at 7.52%, just for purposes of discussion. And then because we're putting less than 20% down, we're likely to have mortgage insurance. If a borrower has excellent credit, really good debt to income ratios, it's probably going to be very competitive, maybe even less than what it's showing here at 0.35% per year. And then we factor in homeowners insurance, $94 a month. That sounds about right. Taxes at about 1.2% annually. So anyway, So let's take a look here. So if we have 10% down on a $515,000 purchase, with those factors that we just discussed, we would be sitting at a monthly payment of $39.91 per month. Now, the average rent for this area on a property similar to this is probably going to be $2,500 to $2,800 per month. And that's something to consider. So, when you're renting a property, the rent is generally going to be the most amount that you pay, right? You have your rent payment, and then you have your utilities. But with the mortgage payment, you have your mortgage payment, then you have your utilities, then you have the expenses that are needed to run the property, like the upkeep, the maintenance, the capital expenditures. If an HVAC system goes out, you got to replace that. So anyway, you can see that based on where we are today, there's a reason home affordability is strained. In fact, let's look up the median income for Sacramento, with the median household income coming in at about $79,000 per year. You can see why the housing affordability is really strained. Now, if we know affordability is so strained in today's market, how come homes are still selling? I mean, wouldn't we see prices coming down? Wouldn't it sideline more buyers? And the answer is sort of. It's more nuanced than that. Right now, the reality is, at least in our local market, we have a shortage of inventory. At this moment, Sacramento, Placer, and El Dorado County, these are my local markets, this is not national, but we still have less than 2 months worth of inventory available today. That means if nothing else hit the market for sale starting now, it would take less than 2 months to sell everything that's out there. And the fact is that there are enough willing and able buyers to meet the amount of supply that we have. In fact, they're exceeding it. And so homes transactions are still taking place. Now, there are reasons why you would buy a home right now, even if the numbers aren't completely making sense. And this comes down to life circumstances. So if you've never heard of this, we call them the 5 Ds of real estate. Now, these are often moments that drive people to make these significant moves in the world of real estate or property, anything from joyous to challenging occasions, but they're life transitions. So they call them the 5 Ds: divorce, downsizing, diapers, diamonds, and death. And I can actually speak to this just a little bit because we're going through it right now. My family and I, we're in a position where we really want to purchase a home, because the home that we're in, even though we absolutely love it, the walls are closing in. It's a little small for us. Our kids have to share a room. It's in an area we love, but we've basically gotten priced out of our own neighborhood based on where prices are and where mortgage rates are. And so we've been looking for a long time. We've even made a few offers. We've sort of gotten outbidded, unfortunately, because there's a lot of competition in this particular area. And so we're in the situation where our life circumstances are changing. Our family is our kids are just getting bigger. They're going to need their own room. We need more space. And so we're looking at this on a longer term time horizon as to what our needs are now, but also what our needs are going to be in the future, along with trying to balance it with a monthly budget, which can actually be really challenging. And when you work with a mortgage professional and they get you qualified, one thing that I want to point out to those of you who are listening is that what you qualify for versus what you can afford on a monthly basis may be 2 completely different things. Because a mortgage professional or an underwriter, they will underwrite to a certain debt to income ratio. So let's say, for instance, you make $10,000 a month. For easy math, that's gross income before taxes. And an underwriter will allow you to do, let's say, they'll allow you to have maybe 45 to 50% debt to income ratio, meaning your monthly expenses, things that show up on your credit report, like your mortgage, taxes, insurance, credit cards, car payments, student loans, you can have up to about $4,500 a month in those monthly expenses. But it's not taking into account other things like food, insurance costs, maybe childcare, big expenses. And it's going based on gross income in most cases if you're a W-2 wage earner. And we all know that if you earn a W-2 wage, if you just work for a company, and let's say you earn $10,000 a month, well, you're probably taking home 70% of that, let's say, which is $7,000 a month. So if you have $4,500 a month outgoing in liabilities, things that show up on your credit report, it really only gives you a couple $1,000s extra as discretionary spending. And that can start getting really, really tight. And so these are just simple things to be aware of. So anyway, my feedback or not necessarily advice, this is not financial advice, but it's things to potentially consider. If you are a home buyer in today's market, I wouldn't say don't buy, but I would say is there an immediate need? Is there a life circumstance that requires you to purchase? That's number one. Is there a reason why you're doing it? Number two, what is your time horizon? Are you going to live in that property for 2 years or 10 years? Because you're going to have two completely different conversations. Right now, if you're looking to purchase and hold for the long term, I think it's ultimately going to work itself out over several years and things are going to be okay. Wages will generally go up. A lot of times we don't take into consideration the variables and what will change in the future. A lot of times as we get a little bit older, we gain more skills, our earning power increases, and we start earning more money. And the mortgage payment that we signed up for 5 years ago it begins to feel smaller, even though nominally it's the same amount, right? The other thing is that if mortgage rates go down in the future, you can take advantage of that. You can basically take advantage of what the market gives you. Rates go down, you may be able to refi, drop the rate, lower the monthly payment, improve your overall situation. So anyways, long-term time horizon, and then mainly stable employment. Is the employer that you have, did you just go to work for them? Have you been working for that same company for 7 years? Do you have stable income? Are you all on commission income? These are all things to basically take into consideration if you want to buy today. The other thing that I think is super critical, kind of shout out to Dave Ramsey. I think he kind of coined the term, or at least made it really famous, but the emergency fund. If you can, after paying the down payment and the closing costs, if you can have leftover 3 to 6 months worth of expenses as a buffer in case of emergency, I'm a huge advocate for that. I think it's a must-have, especially in today's market, especially when we're looking at monthly payments that have increased substantially. So anyway, that is my 2 cents. That is why I think transactions are still taking place, even though they are at low levels. Life circumstances are forcing these. I think it's going to continue to happen. I mean, think about it. Even in 2008, when the housing market, quote unquote, crashed, transactions tongue-tied. They were still taking place, albeit they had a lot more inventory at that time, and the situation was completely different. So if you're on the sidelines and you're waiting for the housing market to crash or prices to see this big correction, I mean, with the lack of inventory and the setup that we have here in the market, I don't think that's coming, but who knows? So anyway, hope you found some value in this video. If you did, consider hitting that like button, subscribing. I appreciate you taking the time to watch this. Leave me a comment below. What do you think? How do you feel about the market? And we'll see you on the next video. Take care.